Welcome back, everyone. In today's video, we're continuing our journey as we cover part 2 through 5. If you haven't watched part 1 yet, I highly recommend starting there before continuing. Let's dive straight in, where the methodology transfers across markets. ICT's own framing, paraphrased or summarized, from repeated secondary description, not a verbatim quote. The consistent explanation attributed to him across many independent sources. Markets are not random. They are driven by large institutions needing to fill large orders without excessive slippage, which creates repeatable footprints, liquidity pools, imbalances, or fair value gaps, order blocks, wherever that same institution dynamics exists, regardless of the specific ticker. Independent market microstructure explanation. This part is independently verifiable and doesn't depend on ICT at all. Any centralized or quasi centralized two sided liquid auction market, an exchange listed stock, or a sufficiently liquid OTC market like major pair FX shares the same basic mechanics. Large participants must execute size without moving price against themselves. Resting stop loss and limit orders cluster at obvious technical levels, creating liquidity, and price often reprices quickly through areas with few resting orders, creating imbalances akin to ICT's fair value gap. Human behavioral patterns repeat across retail participants in every market. Clustering stops below obvious swings low, chasing breakouts, etc. This is well documented in market microstructure and behavioral finance literature independent of ICT. Because these dynamics are about market structure and participants' behavior, not about the specific asset, a framework built around them will generalize far more than a framework built on asset specific fundamentals. For example, crop yield reports of corn futures won't transfer to Bitcoin, but large order create liquidity voids does. Separating the two explanations. Institutions move price to accumulate or hunt liquidity, and this happens on every liquid instrument. Any two sided auction market with large participants and resting retail orders will exhibit similar liquidity or imbalance mechanics. Most commonly asked question: which markets does ICT personally prefer or teach most? Based on consistent cross source reporting, multiple independent ICT focused sites coverage on the same answer, which arises confidence even without a primary code. Nasdaq 100 NQ futures, repeatedly cited as his most used instrument in the 2022 model, and recent lectures, E-mini S&P 500 ES futures, constant companion to NQ in his teaching examples. Euro USD standard Forex teaching pairs since early mentorship. GBP or USD paired with Euro USD in nearly all Forex focused lessons. Documented in 2019 Twitter trade tracking thread by a student. Secondary but time stamped and specific. XAUUSD gold, frequently named alongside the major Forex pairs in recent content. Dow Jones US 30 YM, mentioned as part of his index focus, lower frequency than NQ or ES. No such result surfaced a ranked or explicit statement from ICT himself on Treasury futures, oil CL, or silver SI, or personal favorites Where sources mentioned these, it's in generic. You can apply ICT to lists, not I personally trade this. Why reasoning offered by secondary sources? Index futures, NQ or ES, are repeatedly described as offering the cleanest time of the day delivery because CME session structure creates sharply defined open or closed liquidity events that align neatly with his kill zone framework. Cleaner in this telling than fragmented OTC Forex liquidity. Preferred currency pairs Euro USD named in nearly every Forex focused ICT teaching source found. GBP USD, XAU USD gold, technically a meta, but taught alongside FX pairs. USD JPY, AUD USD, USD CAD. No search result found him explicitly recommending a beginner start with the exact pair or a specific pair he discourages. Several secondary study guides recommended Euro USD for beginners on the reasoning that it has the tightest spread and highest liquidity. But this is the guided author's advice, not a sourced ICT quote. I am not attributing it to him. Why these pairs independently or inferred reasoning? Euro USD and GBP USD are two most liquid, tightest spread major pairs. Trade heavily during both the London and New York kill zones his model is built around. And their price action is dominated by large institutional or interbank order flow rather than thin retail volume. All factors that make ICT's liquidity order flow concepts easiest to observe cleanly. Futures contracts ranking, cross source convergence, no primary ranked statement found. NQES YM 6E Euro FX futures, GC Gold futures, RTY Russell 2000, ZB or ZN Treasuries, CL crude oil, SI silver, 6B British pound futures appear in generic ICT works on these two lists across secondary sources, but none of these search results attributed a specific stated preference for those to Hudson personally. Why he favors NQES? Reasoning attributed to ICT adjacent educators, not a verbatim ICT quote. The recurring explanation: index futures offer transparent, exchange published volume and open interest data, standardized contract delivery, and clean session based volatility windows, all of which make liquidity order flow concepts easier to demonstrate and teach on a chart than OTC CFD price feeds, which vary by broker and lack a single authoritative order book. CFDs. No direct ICT statement on CFDs, positive or negative, was found in this research. This is a genuine gap, not an oversight. If he has addressed it explicitly, it's likely in a specific video not indexed by search, but can be said responsibly. Independent fact: a CFD, contract for difference, is a broker issued synthetic derivative that mirrors an underlying instrument's price but is not the underlying instrument itself. It typically not exchange traded and is often illegal or restricted in jurisdictions with strong retail protection regulation. For example, the United States, which is a large part of why US based traders following ICT often gravitate towards CFTC regulated futures instead. Why ICT concepts still work on CFTs objectively? but because most reputable CFD brokers price their feeds directly off the same underlying interbank or exchange data. With a markup or a spread, the price action a CFD trader sees is for major liquid instruments extremely close to the real underlying market. The liquidity or order flow logic ICT teaches describes the underlying market's behavior. A CFD is, for major pairs and indices, a reasonably faithful mirror of that behavior, even though the contract itself is synthetic. The main practical limitations are potential price or spread discrepancies during high volatility, broker specific execution differences, and the absence of a real centralized order book unlike a futures exchange.